This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Wild speculations about lagging economic data releases, and then questioning the notion of recent shows with now more data applied, all on this week's Wise Investor Show. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and by the time you hear this recording, we'll have received the May employment data, which is one of the more relevant economic releases right now. And I don't have it in my hands right now. I'm recording before it comes out. So I'm not going to guess, but I will speculate. I wouldn't be surprised to see the non-farm payrolls come in a bit below the consensus estimate, which is for right now they're estimating a creation of 180,000 new jobs in the United States in May. And maybe we'll even see the unemployment rate tick up to 4%, which, if this all does somehow happen, I would expect the market to thoroughly enjoy. That 4 handle on unemployment with a 2 handle showing on many inflation data points now, albeit with some still over 3, that would indicate to the stock market that the Fed is ready to now give us some sugar. Now, it's the perfect time for it. The pundits have now swung too far in the other direction, going from expecting numerous cuts this year to now many expecting no interest rate cuts this year, but we'll have to see. I'm not just picking numbers out of a hat here, and I'm certainly not leveraging to this thesis, nor should you ever make a weighted decision based on a notion you hear on this or any other podcast. But I think that the outcome is possible because the JOLTS jobs report showed a little bit of a softening in the availability of open jobs right now. Not terribly many, but some softening below expectations. So this will sound really dumb if by the time you hear this, we actually got over 200,000 jobs created in May and the market goes down by 2% on Friday. Anyway, also in the face of this, though, the European Central Bank, the ECB, well, they gave their first interest rate cut in the cycle on Thursday, really in almost a symbolic move, moving their 3 key benchmarks down by 0.25%. And it was widely expected, and it's actually historically somewhat unusual in that they don't typically lead this cycle. The U.S. does. But their measurements of inflation and economic activity have been lower in both accounts than ours have. So they're a step ahead in this cycle, although they seem less concerned with the concept of a start and stopping here. It's as if they took a step into the kiddie pool and they look back at mommy, that being us, and they look to see if it's okay. They would love to have lower inflation and to start cutting, but again, we'll wait and see. In the meanwhile, this has continued to rally the dollar, which causes all sorts of problems around the world. Today, the U.S. dollar is at a multi-decade high, while at the same time, cost of oil has largely started to head lower. In fact, the Saudis recently indicated a willingness to pump more oil by the end of this year. So a strong dollar and cheap oil itself, on its own, would seem to indicate it's time to flip this kind of contrarian script on inflation. Everyone's saying we're not going to get cuts. Well, let's go to the other side and say, well, maybe we will see some cuts, leading to a hope, if not an outright expectation, that we'll see cuts sooner than later. But the need still isn't there if we don't see jobs cuts, if we don't see unemployment ticking higher. The Fed is not in a rush. But according to the Wall Street Journal this week, the dollar now is just short of where it was when Nixon took us off the gold standard. So if you're an American traveling abroad or you're looking to buy European products right now, they're going to be relatively inexpensive. Also, the U.S. imports a lot of food. And that food which we do import, we import often from third world nations for the most part. And they're the ones getting beat up by a strong dollar. It's easy and it's cheaper for us to buy strawberries and blueberries in January now. But these countries and most of the emerging markets are forced to do their borrowing in dollars. And that interest expense is really hurting them right now. Their currency goes down. Our currency just gets stronger and stronger versus it. And they got to pay more and more in interest expense, forcing them to export more and more of that which they can produce, leaving less and less for home consumption. Now, in the journal, again, it said, quote, Think of the Fed's policy stance as higher for longer than almost anyone anticipated because the U.S. economy has been stronger for longer than almost anyone imagined, end quote. So now it's time to pivot to the under and prepare for a weakening economy and interest rates cut sooner than the market now expects, which I say only somewhat tongue-in-cheek here. And to that point, we had an important leading economic indicator released this past week. We got the Chicago PMI survey, and that's a really wonderful barometer for overall business activity with that proverbial green light for any reading over 50. Well, for the May reading, which also plays into that jobs guesstimate I made, the actual reading was 35.4 versus an already pessimistic estimate of 41 and the prior period reading of 37.9. So kind of a deteriorating economic activity reading there. The jobs report itself is a lagging indicator, but it's a key part of the Fed's mandate, while this PMI report is a leading indicator, which plays into the results then that you'll find in something like the JOLTS jobs report, and then ultimately then the jobs report. So it may be early, but these are the signs of more, let's say, tepid waters at best. However, monetary policy might ultimately have a less powerful impact on the real economy than in the past interest rate cycles, partially because of the legacy of ultra low interest rates that prevailed from really 2009 to 2022. And as a result of that period, millions of homeowners are sitting with 30-year mortgages. Well, now there might be 20-year mortgages, but these really, really cheap loans at rates well below 4%. And corporations likewise often took the opportunity to refinance at historically low interest rates and extended their borrowings, while many of the largest U.S. companies now are net interest earners. When I come back from a short break, I'm going to add some details to that narrative, the one I had a couple of weeks ago when I talked about the threat and risk of all this debt that's coming due at a time when interest rates are now substantially higher than when these loans were last made. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Will the Magnificent Seven continue their spectacular run? Be careful relying too much on last year's playbook. I'm Simon Hamilton, Managing Director and Portfolio Manager with the Wise Investor Group of Raymond James. Every week, we discuss the latest financial trends and what investors need to know. To learn more about where to find the best future opportunities and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. So a couple of weeks ago, I was focused on the looming threat of debt in the economy. I was using part from Howard Marks, who was just talking about the risk of leverage in general, and that is always something you want to be on the lookout for. Certainly if you're looking at what your kids are up to, but certainly also the companies you're dealing with. But I was talking about the risks of what the cost of debt is. Not so much, although sometimes the threat of debt crippling companies, defaulting, but really rather the larger, more prevalent threat of debt resetting at substantially higher interest rates and what that will do to corporate earnings, even if the company's operations, their sales practices remain rather healthy. Although, if it really does grow into a persistent problem, if it starts to snowball, well, it would start taking a chunk out of the top line results also, right? Because you would start translating to the top line of other companies as businesses themselves would have less capital if the debt becomes more expensive for expansion and for spending and such. So it would snowball to business and so on. However, the most obvious and overall likely most dangerous part of it all is the debt held on commercial real estate. Maybe it's not that obvious, but this is what troubles me. Most aspects of which are also suffering from lowered vacancies. So it's not just the debt, but what the operations are, but also cannot keep up with their debt service. And that's already happening. And it becomes then a risk to the banks that made these loans in many cases. But instead of that, let's look at the bigger picture, like I was alluding to a few weeks ago. Let's look at the corporate world. Let's look at the stock market from 10,000 feet using some actual data we pulled this week from FactSet. The methodology that was applied here was to use all of the companies in the S&P 500 except the financials. We excluded the banks and the financials because looking at them, their balance sheets in the same way as a more typical, like an industrial or a tech company or what have you, it's not apples to apples. So we excluded the financials. We really want to get a feel for the rest of the economy. But we also used the constituent members equally, not by market cap, because I didn't want the picture to be confused by the massive weightings in the index of these big tech names, which themselves often carry very little debt. And I'll tell you what, the conclusion, I guess I would say, is pleasantly surprising. It's not a total nothing burger, but using the whole sample size and looking at what's coming due over the next few years and what it takes to get these names to borrow today, what it costs based on their respective credit ratings, the hit to earnings wasn't disturbing, albeit not nothing. The basic bottom line is that over the next 3 years, assuming today's interest rates and that this debt is reissued at what it would cost to issue today, and that it won't be retired, or maybe that the company actually would increase their leverage, but let's just say steady borrowing over the next 3 years, the interest rate expense overall increases by $28 billion. Sounds like a lot of money, but it's 0.2% of sales. And over the next 5 years, using those metric, by a bit below $50 billion, or 0.35%. Total debt has increased these past few years, whereby total debt in this sample, in this pool, it's a bit below $7 trillion today, up from $5.6 trillion before the pandemic. It was at $5.6 trillion in 2019. But the cost of that debt today is 3.5% on average versus 3.3% in 2019. So it hasn't gone up that much. And that reflects that many companies, especially the biggest ones, and that's what's in the S&P 500, they're able to access the borrowing windows when interest rates crashed to near zero. And they got a lot of their exposure lowered and pushed out further, just as many of us did with our mortgages. And I remember in the teeth of that pandemic, closing on a refi on my house, sitting on my front porch. Also, net income has substantially improved since 2019, up about 50% for the overall index, and net debt is up 25%. So as a portion of earnings, debt has actually been reduced up to now. Now, there is over $1 trillion worth of debt maturing over the next 2 years and over $2 trillion over the next 4 years. And it's going to have some impact on the bottom line as a modest percent of sales on average, less than a 1% overall impact on margins. So the takeaway this week is that this isn't an overall looming crisis. I want to make sure that we're not sounding like Chicken Little on this show. I still do lose a bit of sleep, literally, over the tendrils that could develop from commercial real estate defaults and what might pop up there. But we've circled the wagon as far as our direct and secondhand exposure there. And for the average company in the S&P 500, it's not too big an impact. There's still some noise in these numbers because of the companies that carry very little meaningful debt. But this does a reasonable job of diverting our thoughts from that it's a bigger overall market issue. Instead, because the numbers are overall still substantial, if not wholly impactful, it returns us to thinking and examining businesses on an individual case-by-case basis, as some certainly have a lot more coming due than others, and some are going to be borrowing at much higher rates. And if that combines with a business that by normal operations manages very thin margins, like a company that has low single-digit operating margins, then this is a very real issue. Well, for others that have high margins, and very little debt, at the end of the day, this whole story might be outweighed by the net returns. And instead, some of these companies are now booking quarterly as they get net interest income on their cash holdings. What's also missing from this discussion is the effects of debt on smaller companies, private companies, and those that are not able to borrow at the most favorable rates, like most of those in the S&P 500 can. So again, your mileage may vary, and keep looking under the hood at the balance sheets, especially if you're dealing with maybe a more esoteric or a smaller name. All right, that's all I have this week. I'm Chase Hinderstein, and as always, I appreciate you taking the time to listen in to the Wise Investor Show podcast.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.